Hi, I'm Christine Benz from Morningstar.com. Social Security is a valuable asset, but should you consider it part of your household balance sheet? Joining me to discuss that topic is financial planning expert Michael Kitces. Michael, thank you so much for being here.
Great to be here, thanks.
This topic of how to consider Social Security as part of your total wealth portfolio is really a hot one among Morningstar.com readers. You recently did a blog post about this topic, and I'd like to talk about some of the attributes that you mentioned in your posting that make Social Security so valuable, in a lot of ways quite unique relative to traditional portfolio assets.
Yeah, I find this to be an interesting dynamic. So, the reality is we use assets to produce income streams. And Social Security really functions the same way. It's just in kind of in reverse. Like, it is the income stream. We don't ever see the asset. And pensions were the same way. But there is an asset. Not only is there, sort of classically an asset that funds pensions, but with something like Social Security, we can actually value what that asset equivalent would be. Like, what kind of asset would we need to replace the income stream of Social Security over our life expectancy or over our lifetime? And the interesting phenomenon is when you actually try to value that as an asset, like how much money would I actually need to produce that kind of retirement cash flows? It's an impressively valuable asset. So the math will vary a little depending on what your rates are, whether it's just your benefit or also pushes out a survivor benefit. But we see a lot of client situations where the value of Social Security could be $200,000, $300,000, $500,000, sometimes even as much as $600,000 or $700,000 for married couples when we get both benefits going. Like, that's a big asset, right, for a lot of people to have there on their balance sheet, and we don't really think about it that way because we never see the Social Security account balance that's there. But it is an asset, and it's a really material one.
Right. So in a lot of ways, it's like a TIPS bond, a Treasury inflation protected bond. Yeah. But in some ways, it's even more valuable.
Yeah, it because those Social Security payments have that cost of living adjustment attached to them, they really do function like an inflation adjusting government bond. And frankly, if you were to try to value it on your balance sheet and you sort of watch the value over time, that's essentially how it would behave. So if inflation ticks up, your inflation adjusted payments are going to be higher, and so it becomes more valuable as an asset. If interest rates go higher, the discount rate gets a little bit higher, it gets a little bit less valuable as an asset. And so it really does actually function very much like a TIPS bond, with frankly the caveat that because all of the Social Security payment formulas are pretty much locked in back when we last changed the system, which was the Greenspan Commission in 1983, it's frankly a really nice TIPS bond because it's based on payouts that we calculated back in 1983 with those mortality tables and those interest rates, and obviously things have gotten a little bit different in today's environment.
Right. So one thing that there's certainly been a lot written about has been recently, especially, has been the value of delaying Social Security. Yep. And you say that in the current low yield environment for bonds, that's a strategy that's particularly attractive right now.
It really is. Social Security delay, like there's been more buzz about it over the past couple of years, which I think in part is just more baby boomers reaching retirement, so just there are more of us that have to make this decision, so we're facing it more regularly. But the value of delaying Social Security truly has changed from where it was just 10 years ago. Part of that is that interest rates are lower right now, and so if you think of the Social Security delay decision as, if I got to get my money somewhere, so either I can draw it from a portfolio and delay Social Security, or I can take Social Security now and let my portfolio stay invested. Well, Social Security is like a giant bond, but it's a bond that has this really appealing return attached to it. You'd rather spend the bonds in your portfolio and let Social Security grow than spend Social Security first and let the fixed income portion of your portfolio grow. And when we look at it with that kind of trade-off, it looks even better in low-rate environments because now the bond portfolio is doing worse and the Social Security asset is doing better. And frankly, it looks even better because the delayed retirement credits that you earn for delaying past Social Security only recently got to the point where it's an 8% annual increase for everyone. If you go back 10 or 15 years, it was only about 5%. If you go back to the early stages of the Social Security system, it was only 3%. So we've actually shifted the system to make it more beneficial to delay retirement in general, I should say, delay Social Security benefits. And then in a low rate environment, it becomes even more exponentially more valuable. And so it's literally like your asset appreciates more rapidly. The Social Security as an asset appreciates more rapidly when you delay it certainly than the bonds in your portfolio. And frankly, I can even make the case that it's got a better risk-adjusted return than probably equities in today's environment.
Okay. So another thing we're thinking about, though, is that in perhaps a more normal interest rate environment for people who aren't close to retirement at this point, that in fact that decision to delay may not be the slam dunk that it is today. Let's talk about that.
Yeah, so I kind of, as with any asset, as you're trying to manage the asset and figure out how to invest it or how to use it. Yeah, when we get to a higher rate environment, that delayed decision may not look as compelling relative to maybe a bond portfolio or blended portfolio that's looking a little bit better on the return side. So it will be, I think, a little bit of a dynamic formula, right? Like that's why planning around retirement and Social Security is sort of the puzzle that it is, because the efficient strategies for it really do depend on the outlook for the different assets on your balance sheet. Social Security is one of those assets, and how good or bad it is really does vary from one to the next. And frankly, if at some point in the coming years we change the Social Security system a little bit, we know we need to make some changes. We can all see where the projections are going in 15 years. Changes to the Social Security system may or may not further tinker with that formula about whether you're delaying or not. So frankly, I guess it's not the most uplifting thing. But like, if you're in your 40s today or younger, I don't know whether you're really going to be delaying Social Security by the time you get there or not. We're going to have to see what the rules look like when we get there, not to mention just interest rates and the rest of the environment. If you're in your 50s, you probably still going to delay, but you can see exactly what things look like when you get there. But if you're already in your 60s, and you compare essentially like a supercharged government bond, TIPS bond return that you get off of delaying Social Security versus your other assets, it becomes really compelling to delay Social Security in this environment. I know the question I always get is, yeah, but I really want to spend my portfolio down for my Social Security to grow bigger? And the answer is yes, you really do. It's that growth of your Social Security asset is giving you a better risk-adjusted return in most cases than what most people are getting off their portfolios, especially if they're fixed income heavy in their portfolio at today's rates. And obviously the caveat is if you have a reasonable life expectancy. If we know our life expectancy is short, we're in poor health, it's still pretty much take your money while you can get it, and take your money and run. But once you've got even just an average life expectancy, it becomes pretty compelling because, again, Social Security's formulas were balanced based on life expectancy in '83. Our life expectancy has gotten better. So merely average health today means you're actually winning the life expectancy mortality tables from relative to where Social Security was priced.
Okay. So the big question is, if I've got this investment portfolio and I've also got this asset, Social Security, whether to consider the Social Security piece part of my kitty and let it affect my asset allocation. Jack Bogle has said, target date funds are doing it all wrong because they're not factoring in the role of Social Security as this bond-like asset. Where do you come down on that question? And specifically, I'd like to hear from you as a practitioner. How would this work in a real-world client environment, telling them that their Social Security is effectively a bond?
Yeah. So this is a funny challenge because I really have to come at this with two different hats. So if I kind of put on my academic researcher hat for a moment. Frankly, I think absolutely Social Security should be an asset. You should be looking at it on your balance sheet. You should be comparing it to the rest of your balance sheet because it's not only is it an asset, a very material one for a lot of retirees, but it's an asset with really unique characteristics. And frankly, I think if we put Social Security on the balance sheet and you said it's like a TIPS bond that gets better returns than any other TIPS bonds, and then you say, look, here's this big Social Security asset with a great fixed return, and then here's your portfolio with low bond returns. Would you rather spend from your portfolio first or Social Security first? It actually becomes quite obvious. Well, of course, you'd spend from the lower portfolio return first and let the Social Security asset grow. That becomes very obvious when you view them as assets. And Social Security is also unique because it's an asset that really behaves differently than every other asset in your portfolio. It effectively gets more valuable in low return environments because the discount rate we use to calculate its value looks better. It gets more valuable in high inflation environments because its inflation adjusting, and it gets more valuable the longer that you live because it's a payment stream for life. And when we compare that to the rest of the assets in your balance sheet, like the portfolio is basically the opposite. Portfolio does worse when you get bad returns, high inflation, and you live longer than you expected. Social Security does best when you get low returns, unexpected inflation, you live longer than you expected. So if you're trying to manage risk for your whole balance sheet to make your retirement, or can you put Social Security there as an asset, I think a lot of those trade-offs actually become clear as to why it's so good to delay Social Security and keep your portfolio. Now I take off my academic research hat and I put on kind of my practitioner hat as an advisor that sits across from clients. This gets messy really fast. So if you imagine someone like a married couple, they were both working for their careers, they've accumulated a really healthy Social Security benefit. Married couples will see things where the present value of their Social Security could be $600,000 or $700,000, even more sometimes in today's low rate environment. And they've got this nice $750,000 401k retirement nest egg that they built up. We sit down and say, okay, you're relatively conservative. You only want to be about 40 or 50% in equities overall. You've got a $750,000 portfolio and almost $750,000 of Social Security. The Social Security clearly has to be a bond. I can't change that. So if I want you to be 50-50, I'm going to take your entire 401k. I'm going to put 100% in stocks. You will be all in on equities for your portfolio. Now, again, wearing my academic hat, no, you're a 50-50. Right. Social Security is just a little bit less liquid. Your portfolio is a little bit more liquid, but you really got to look at this whole thing as you've got a $1.5 million net worth, including this Social Security bond and this portfolio stock. In the real world, when you're sitting there and you're looking at the only thing you get a statement on, which is the 401k or the IRA, and you watch real world equity volatility and you go through a scenario like 2008, it's going to be terrifying. Like I just sat across from clients, like I know what this looks like. We mentally, this is all the behavioral research, like we mentally account for things into buckets. We don't really mix the Social Security bucket in our head with the portfolio bucket. And so when you look at a portfolio bucket that's 100% in equities and the kind of volatility that produces, it's going to get a little scary. So I don't know there's entirely a workaround for that. I mean, we truly get into now like what I would do in the hyper-logical, rational world versus just what we do in the real world, the way that we think about our money. And it's tough. Now, the good news is as you draw on your Social Security over time, that bond asset basically depletes itself because you're getting the payments, your life expectancy is getting shorter. So we actually slowly get there over time as our Social Security spends down and our portfolio stays even or even grows in the early stages of retirement. We're actually shifting to be a little bit more equity centric, and that's actually a good thing. So as we've talked about in the past, like we did some research that found that portfolios that drift higher in equities in retirement is actually an okay thing. So you kind of get there over time as your Social Security assets spend down naturally and your portfolio grows or at least stays even in your sort of percentages of net worth shift. But yeah, like academically, you really should invest around it. Real world, that's harder. I think certainly we can invest around it to the extent of saying, this Social Security asset that we delay really has unique investment characteristics that are very compelling, especially in today's environment. So we're going to delay the Social Security and draw from the portfolio first, and we can get that far. But to actually say like, no, your portfolio should be 100% in stocks because it's being counterbalanced by this 100% bond position in Social Security, even though you'll never see that account balance. That's hard. Just real world, what's it going to be like when you're looking at that statement? That's hard. Okay, Michael, such an important set of questions here. Thank you for being here to share both your practitioner's perspective as well as the academic perspective. My pleasure. Thank you. Thanks for watching. I'm Christine Benz for Morningstar.com.